so the third one we have here is stocks and shares. Now, what I mean by stocks and shares, I mean individual companies. Ultimately, when you're buying a share, you're buying a share in that company. Pretty self-explanatory. The same with the stocks. Stocks are just generally US terminology for the same kind of thing. Maybe there are some intricate differences, but you know what? Who cares? We're looking for trade. We're looking for volatility. We're looking to make some money from the movement in these prices. So let's look at some big ones. So in the UK, we've got, let's look at the UK. You've got things like Vodafone. You've got things like Tesco's. You've got things like JD Sports. You've got things like Marks and Spencer's. We could go on and on. So just some big kind of brand names, if you like. In the US, we've got things like Alphabet, which used to be called Google. We've got things like Netflix. I'm just using some of the ones that come off the top of my head here. Tesla, electric car manufacturer. We have obviously Facebook. We've got Twitter. We've got Snapchat. We've got US Steel. I could go on and on and on. But let's look at some of the most popular ones, and let's look at some of the ones that perhaps are good ones to trade. One of the most popular ones in the US to trade is Apple. Okay, Apple is a good one to trade. It's calmed down a bit over the years. They've kind of found, when they were first out, there were there's a lot more volatility out there. There's a lot more urgency about what they were going to do next. But Apple is a good one to trade. But Apple really goes hand in hand with how people are perceiving the next product. It's very fickle like that, because the shareholders are very sensitive, and traders and fund managers are very sensitive to them losing market share to some of the other smartphone providers. They want to see innovation. Apple has got an enormous amount of cash they're sitting on, so there's no doubt they're a great business and a profitable business. However, the thing to remember with shares is that is factored into the price. There's no real value in saying, you know what, Apple's a great brand, they're making a lot of money. That is already factored in. Everyone knows they're a good brand, whether you're an Apple fan or not, it doesn't matter. Everyone knows they make money, everyone knows they sell product, everyone knows they come out, they make good products, people will buy them. People are embedded with the brand, people are coming new into the brand, some people are leaving the brand, but ultimately they're a good money-making company. However, the things that will affect stocks like Apple are going to be when they release a new phone. The new phone comes out. If people are just disappointed and are not going to take it up, the stock may well fall. It may well think, well, then it will fall because people will assume that phone won't sell very well. So when they come out with the next layer of earnings, they may sell less iPhones than expected, which is going to cause a further fall. And they may think that actually there's a cycle of poor design, poor sales, poor innovation, whatever it may be. So that is something that's going to affect that company. It's the same with any of these companies, guys. It's a case of looking at what affects it. Now, okay, I'm looking at this from a pure perspective of what's affecting the price. You may well look at it purely technically. You may say, I don't care about that. All that kind of stuff will be reflected in the chart that I'm trading, whether it's a swing chart, whether it's a a daily chart, it's 15-minute chart, whatever. Obviously, if we're trading for 1 minute or a 5 minute, you don't really care about the ultimate daily or monthly movement, but just kind of a broad view, because even me as a day trader and someone who prefers to day trade stuff, I like to know what is moving the market and what people are thinking, because ultimately I'm trading against somebody else. If I know what's making them make a decision, then perhaps I can kind of second guess their decision a little bit and then front run it and make some money from that. I won't go into too much depth about the strategy. Facebook, the big thing about how they can monetize, especially mobile. The issue was they were doing very poorly at the beginning after the IPO. If you remember the IPO chart, it was a little bit like this, and now they're up at highs because they were just struggling with monetizing mobile. That everyone knew that everyone was shifting to mobile. How could they run ads on mobile without losing people? They figured it out. They made money. Tesco's, on the other hand, a UK stock, they were doing very, very well, making loads of money. It was a case of how do we expand more? We've got a really good market share in the UK. We're going to move to the US and try the Fresh and Easy brand. Absolutely flopped. Had another few ventures that absolutely flopped. Struggled with the UK. Too focused on Sainsbury's, too focused on Morrison's. Didn't watch the German Aldi and Lidl coming up the outside of them. Lost a lot of market share to those guys. So while that may well influence you if you're swing trading looking for a multi-month move based on earnings or based on predicting perhaps the earnings cycle, not very useful for a day trading perspective, but either or, it depends on the strategy you employ. So some of the big ones, Vodafone, very, very big market cap, not so volatile. Tesco, again, it's a bit of a story stock. And you can trade these based on the story you've got behind. If you're swing trading, if you're day trading, a little bit different. If you're swing trading, maybe you say the death of retail. Retail's moving from bricks and mortar to online. Perhaps that's going to be it. The rise of tech. Perhaps you're going to say, okay, well, even though these are all-time highs, these are just getting going. Google or Facebook got so much data on people, got so much clout. It's the only place really that people can advertise and get a good return from digital advertising. That might be your thesis, rightly or wrongly. Snapchat, you might say, okay, they've got a good millennial grip in, but millennials are so fickle, they're going to move elsewhere, move over to Instagram, which is owned by Facebook. Perhaps I can pair trade these two. We'll talk about pair trading a little bit later on. But Apple's a popular one, Facebook's a popular one, Google, Netflix, those kind of things. Some of the, sort of other longer standing ones like US Steel, very popular because they were influenced by Trump and his kind of the way he talked about boosting the American economy and building things in infrastructure, and US Steel are going to benefit from that. And then he struggled to have those implemented. So really my advice is to, if you're trading, going to trade stocks and shares, these, by the way, are all going to be, they're going to be higher spreads and more expensive to trade than these, but you're going to have more volatility and you're going to be able to, get in tune with them a lot more. My advice is always to pick a handful. You either look at it two ways. You either pick a handful of stocks or shares that you trade and you know and you love, and they kind of like become your children. You understand how they move, how they operate, what's a volatile day, what the levels are, and you trade those. Whether you trade them on a swing trading or a day trading perspective, or you kind of use a filter and you say, listen, I like to see volatility, or I like to see range bound, and you filter out. The beauty of this is you've got literally thousands and thousands. You can put them into a filter on your platform or on a free filter, and it spits out something that perhaps has had earnings, is really volatile, perhaps has been in a quiet range which suits you. You want to try and fade a mean reversion strategy. However you want to trade it. But that's two ways of looking at it. Another way is to say, if you're a day trader, scanning each morning and seeing what's volatile, what's had the earnings, what's going to be interesting for me to day trade. From that perspective, I want to make money on a 15-minute time period as opposed to a 15-week time period. So loads of options there, good stuff to trade. My thought generally, rightly or wrongly, guys, is that starting off trading with this, your indices, your currencies, because they're broader, they're slightly safer. The trading is very much risky. There's no safe at all in trading, but slightly safer with this because you haven't got gap risk overnight as such. Yes, you do over the weekends with these, and sometimes some of these shut for a small period of time in the evening. But generally speaking, obviously no gap risk with currencies, Monday to Friday, not much gap risk on the indices. A lot of gap risk on these. If some news comes out overnight, then you're going to get a gapping on those. But something to investigate, kind of as an intermediate when it comes to an intermediate level, and also from a swing trading perspective, allows you to strip out specific companies that you like. So this is maybe a bit too broad for you for swing trading the FTSE 100 or the DAX 30. You might say, well, actually, Deutsche Bank, I want to strip that out because I think that's a recovery play or whatever it may be. So really worth looking at, but I think if you're starting, this is kind of the way to go.